it's using diversification, staying invested, looking at the longer term opportunities that there are. It's also taking account of just these are normal challenges.
You're reasonably, relative to me, fresh out of school. Did you get any education on financial investing, saving, reaching goals?
No.
Jeff, how do you teach your guys about the value of money and the value of the importance of investing?
You don't think that actually you need to save for it, and if you want to have some form of life once you've reached retirement, which you've worked for, you need to start doing it as early as possible. And I think that's something, that message really needs to be spread.
Hello everybody and welcome to True Potential podcast number 103. Today's topic is how to teach your children about money. So I'm joined today by some of my colleagues who all have children, but the beauty about today is we've all got children of differing ages, so it'll be interesting what perspectives we've got. It'll be interesting if we've got some common themes as well coming through. I'm joined as usual by Jeff, who will talk about his children at some point, but before that he'll give us an update on the markets because it has been a very turbulent week.
Indeed.
Delighted to be joined by Hayley on her first podcast. Hayley is the mother of a young child and one on the way, so hopefully it doesn't come during the podcast, but if it does, it'll give a different perspective to it. And Jamie, who you've all seen before, and Jamie is the father of young Jack. I have three children who are all of an age that are significantly older than your children, and probably some of them might even be older than you, Hayley. So I'll hopefully give you a different... Yeah, potentially. What we're going to look at today is actually talking about really good habits and how we teach our children. In the words of George Benson, children are our future, so teach them well and let them lead the way. I always have to get a song title into my little appraisal. But it is crucial that we teach our children about money and good habits and how when they get older they will benefit from it. And we'll talk about all sorts of aspects of investing for children, not just specifically products you can invest in, but generally sort of the ethos and how we get them going. But as usual, before we start, I'd like to ask Jeff to give us a quick update on the markets this week. There's been a very turbulent week, not particularly in volatility, but turbulent behind the scenes in what's been happening in global economics.
I think that's right, Steve, and it just really built on what we saw in January of rising volatility in asset markets. And we got off to a really good start to this week in terms of equity market performance, positive days, Monday, Tuesday, Wednesday, but then yesterday we had an abrupt end to that. A couple of factors in the background there. We'd Facebook or Meta's results on Wednesday night that caused quite a reassessment of the value of that company. Share price falling 26% yesterday. $200 billion of market cap lost, the largest market cap loss that we've seen on an individual company. Gives you an idea of the starting valuation of that business, but also it's the size of a number of other companies that have just vanished in terms of market cap. That Spotify results as well, disappointing for people. And then the other thing that's really in the background has just been what's been happening with central banks and changes to central bank policy. So we've touched on the responses that we've seen from the Federal Reserve previously, turn of the MPC here in the UK yesterday, another interest rate increase. The interesting thing within that was just the voting within it. So it was a 5-4 vote, 4 members voting for a 50 basis point, so 0.5% increase in rates, and suggesting inflation's going to peak higher than they'd initially thought. So inflation forecast around 7.25% from 5 where they were. So quite a continued move up in inflation. So really central banks having to get on the front foot. So this discussion of transit rate is kind of gone. We're now moving to try and address the inflationary risk that's there. The UK, that's an interesting dynamic because a lot of our inflation's imported, energy, etc. We don't produce a lot here, so it's not manufactured inflation, if you will, in the UK. And then the other thing, ECB yesterday, very dovish. They've been over the course of the year not expecting much on interest rates, but again coming out and saying inflation causing us a little bit more concern, so potential for rates to move up. So we saw a bit of volatility in sovereign bond markets yesterday as yield curves moved up as a result of that. So many things going on in the background, but the things that we've been talking about, the things that our portfolios have been aware of, being positioned for, and looking for opportunities that volatility does create. And when we look back over the month of January, certainly there was opportunity in different regions and different areas of the market.
Thanks, Jeff. That's interesting. And before we get on to the topic then of investing for children, it's probably prudent to give some advice, not financial advice, but give some opinion really on how our clients and customers and listeners should react when all the news they're hearing, certainly on News at 10, etc., once you've got past the fun and games at Westminster, are quite scary in the sense that, gas prices is the big one at the minute. We're all worried that our heating bills are going to go through the roof. Strange kind of metaphor there, but anyway. What should we be saying to them? For me, it's stay in your seats, but...
Yeah, it's using diversification, staying invested, looking at the longer term opportunities that there are. It's also taking account of just, these are normal challenges. We're coming from a period of time, 2020, COVID, monetary policy, there to support the economy, very aggressive monetary policy. We've recovered. We're now seeing a normalisation of that. It's a natural occurrence. It had to happen at some point. You can't sit with interest rates at zero. It's not feasible. So what we're just seeing, in my view, is a normalisation. And that normalisation comes with increased volatility. That's natural as we move through the recovery phase. So it's about, I think, taking that step back, understanding that we were in a very difficult period. We're now transitioning to more normal period. And as such, volatility will come with it, but staying invested and using it as opportunity as well.
I mean, that's really reassuring. To people who don't know, Jamie and Hayley both deal with our direct clients, so they're calling in. Any themes coming through, Hayley? Anybody ringing up very frightened about their investments, or are people generally still being quite calm and having to pass on Jeff's messages?
I mean, a bit of both, to be honest. I mean, you'll get clients calling up for just a little bit of reassurance, and then on the other aspect of things, you've got clients just basically saying straight away, move us to cash.
Right.
And then again, it's directing them to morning markets, chatting with IM teams, and just to get that reassurance from them. And eventually, once they've actually spoken to someone and realised that that's probably quite a rash decision, that's when they sort of settle down from that point.
Excellent. And interesting what Hayley says there, Jamie. People might want to run to cash. How are you dealing with telling clients not to default to it?
I think we've had, it's funny, we've had two sets of cycles, and I think I keep saying last year, but 2 years sort of drop was a lot more significant than what we're seeing at this minute in time. And going to cash, you've really got to focus on what your objective of your money is. And I keep going back to this, and I say this a number of times over podcasts and sessions, but what is the reason for this money? Because if it's a short-term need, then potentially shouldn't be invested at all. If it's a long-term need where it's actually for your retirement, for your for your children when they turn 18, etc. I talk about Jack's ISA quite a lot. His JISA quite a lot, where he's not going to access that till he's 18. So there's going to be lots of different changes that are probably going to happen. There'll be more drops and more ups in that next 18 years, or 17 years for me now. So you've really got to consider that. It's not a short-term investment. And actually, you haven't lost anything yet. When you lose is when you do put it into cash. And that's the key thing. Unless you've got an immediate need for the money, then potentially you shouldn't be invested. But if you haven't got an immediate need and you've got your goal, it's categorically the wrong thing to do.
Okay. I think the other thing just to remember is that we're coming from a high level in terms of where asset markets have got to.
Yeah.
So we haven't really dropped that much in the grand scheme of the recovery we've had. And I think that's important, that to your sort of starting point, Steve, the headline news would make you think things are an awful lot worse than they've been.
Yeah.
And I think that's the important thing. So what we're trying to do is cut through that noise and be more objective. And actually, things aren't bad. We've seen good economic growth. We've actually seen really good company results. People, obviously, you focus on those big headline ones because they are interesting and they grab people's attention. But if you look in below that and you look at the headlines for other companies that are reporting, they're continuing to report very strong growth. They're reporting good results, and that's there, and that's supporting those businesses. So there's just, it's like a clickbait thing. You put a good headline up there, somebody will go through it and they'll look at it. Whereas if you peel that back a little bit, try and look in below what's happening, there's a different perspective.
The phrase there, Jeff, the one that we should use more often is cut through the noise. We need to help our clients cut through the noise, as you're saying. Right, to cap this first little bit, I'm going to ask you two questions, Jeff. What's the inflation rate at the minute, roughly?
About 5.2%.
And what have interest rates gone to if you're investing in a bank, if you're depositing in a bank?
0.5. But if you're able to get that, that's another question. So we'll probably haven't seen many banks increase their deposit rates up to 0.5 to match what the bank did yesterday.
So in a nutshell, everybody, and when clients are wanting to go to cash, it wouldn't be prudent to do so. And we've made this point before, we need to keep making it again.
Yeah.
Cash is an active investment decision. If you go to it, inflation's eating away at 5 and a bit, and you're getting less than 0.5%.
With forecast to go to 7 and a bit on the bank's forecast, peaking in April of this year.
Good. So if clients are feeling nervous, they want to go, talk to Hayley and her team, give Jamie's team a ring, and we'll hopefully calm you down a bit. Right, the interesting topic now, and the topic that we should, I'm going to ask you some questions in a second, Hayley, so be prepared. I was sort of thinking last night as how we would sort of get into this topic, and I was thinking, right, it's a long time ago since I went to school, and I did turn up occasionally, which was really interesting. You're reasonably, relative to me, fresh out of school. Did you get any education on financial, investing, saving, reaching goals
Not
when
at
you were
all.
at school? Right,
Nothing.
No, I didn't get any.
nothing.
No.
No.
We got maths and English, didn't
Maths,
we?
yeah,
And
that's
all
all
the-
Maths, English,
the
science.
7 hours,
Well,
whatever they were.
I
Yeah.
suppose
Yeah.
a component part of your maths curriculum is money,
Yeah.
but that's the only place it's taught.
Yeah.
It wasn't for me, believe it or not. No. Gosh.
We had a little bit in maths.
Mm.
Yeah.
Crikey. Right, there's the fundamental issue. Do you think we should have it on the... I mean, you think about classic subjects like history. History is lovely. It is useful if you want to teach. I remember my brother's a history graduate. I can't think what other use... I love history, but I can't think what use it is in the workplace. Would it be more beneficial if we introduced teaching children about investing, saving, compound saving rates, etc.? What do you think, Jamie?
Yeah, I think there's two elements of it. You're right. An education piece on understanding why you should save and reasons why you should save would definitely be useful at any age. But also just teaching, trying to teach children the value of money is quite an important area. I think we're better off than we've ever been. I think this is one of these things that David says at lots of these sort of podcasts. But it is the best in terms of the shape we're in. It's the best we've ever been, and you'll find that most children will get pretty much what they, and there is obviously elements of that, but most children will get majority of the one. It's trying to teach that value of money to somebody. I think that's actually important. That comes from the parents, but also can come from some sort of education at school. I think it'd be really helpful.
Yeah.
I think the value is a really interesting subject.
Yeah.
I think we'll deal with that now, and then I think we should... It's almost the technical aspect of investing, though. Leaving, don't touching, letting it grow, compounding.
Yeah.
It's always talked about compound interest. Forget interest. The compounding effect of saving.
Yeah.
How do you teach? I mean, let's start with Jeff, because we've got this. I mean, I can't talk about the values I give to my children, but Jeff, how do you teach your guys about the value of money and the value of the importance of investing?
I think the importance of money, or the understanding of it, comes from, well, you need to do something. You need to work. You need to be building something to actually get money. So using pocket money as a good example, well, you just don't give it. You kind of think, well, something needs to happen for that transaction to happen. So you get to understand that actually there is value associated with it from that perspective. And I think just generally talking to your kids about money, how they use money, how they think about it, how they want to save, etc., is all part and parcel of just giving them that good start in life, that good understanding.
It's interesting because when I was younger, which is quite a while ago, Steve, it's been a little while since I was at school, by the way, but your parents would give you £5 or whatever. I think I used to get 50 pence a day. That was my pocket money.
Yeah.
And now you that's evolved a little bit to Go Henry, or there's other sorts of sites where you can kind of then they get a message on the app when they've done a job, and you can link the cash payment to the job they've done. So they've emptied the dishwasher, which is my most hated job, and that will definitely be Jack's job when he's older. You can go, well, there you go, you've got a couple of pounds, and actually goes on their account and app. So there's some good little, and Go Henry's just one example of that. But there's others that do it. And I said when I was younger, it would be, go and wash your dad's car. Well, I was a good bargainer, so he would start off with giving me a couple of pounds, and I would manage to get a tenner out of him, because he wouldn't have the change. So, but it was that sort of thing. I think that's you can use technology as well a little bit now that helps you sort of understand understand that little bit more benefit of doing a job and being paid for it.
I'm getting a few themes coming through here. It's make them sort of understand that it's a transactional arrangement.
Yeah.
But it's also habits, isn't it?
Mm.
It's
Yeah.
getting them into. We all know that if you get into good habits, if you get into bad habits. So, along the lines of this, how are you going to? I mean, it's very early days for you to start. I mean, they won't understand yet, but you're going to teach them good habits.
I mean, I don't know if it's too early or not. Like, I read
good
something
point.
online the other day, and it was like, oh, your kids should be dressing themselves by 2-year-old and things. And you think, where on earth is that coming from? Like, he's 2 at the end of March, and I think if I put some clothes on his bed for him to get ready, there's not a chance he would put them
They'd
on.
be everywhere, won't they?
Literally. But I think just teaching, like, what you're doing. Like, I'm in the house doing the dishes or putting the washing away or anything like that. It's getting them involved and kind of showing, like, this is how you do something, or like even just folding the washing up. And now he'll sit with his blanket and try and fold it up and put it on the end of the sofa. And I think just little things like that, it can really easily be implemented. But I mean, I'm definitely not getting himself dressed at 2-year-old. But
No, it's
never mind.
probably. I'm just struggling with that now at my age. But yeah, I think it is all about good habits, and we should then move on and talk a little bit about how technology can help. Because they used to have the piggy bank, and I was reading also
Yeah.
that a piggy bank that's opaque is not a good idea. A clear piggy bank's a better idea because you can see as your money grows.
Yeah.
And it's little tips like that, I think, that would help.
I think it is making it visible and using technology, as Jimmy says, because one of the things with my boys is that they put stuff into a bank and you don't see it. Like, where did it go?
Yeah.
Whereas then you have to explain why it's safe, etc. in the bank. But getting it on technology that they can see, it's growing, how it's being used, etc. is probably really advantageous.
The
bring
physical
that
element's
to
gone,
them.
hasn't it? Where you buy a product now, can't remember the last time I paid with cash. When you buy a
Yeah.
product now, it's a card and you can't see anything, so it's a lot easier to do that and not really understand. If you have your piggy bank, as you say, and you've got £50 in there, and you're going to buy your first toy, you realise that actually, wait there, the money's gone, and you can see it. And I think it's sometimes that element. That's why I think the technology is quite important, so they can see their account and go, oh wait, there's £25.
Again, I
That's
think
more.
there's some really important points there. I think it's interesting that saving cannot be seen as punitive to children. And I think that they talk about the carrot and the stick. I think we should almost forget the stick. It's carrot. So it's you do X, you do a transaction, you get money. It then allows you at some point to have something nice of that. And I think it's that how we're all going to manage that along the journey of their life too.
It's also how we think about here, setting somebody's goal. What is the goal that you want to achieve? The exact same with your kids. What is it you want to save for? Set that as their goal, and then you've got something to aim at. And the exact same if we're saving for retirement, we're saving for a special event, etc. It's no different. It's a goal. So you work towards a goal, and that makes it very clear and transparent.
The interesting thing about all of us sat here is I think we've all got boys at the minute. Only
We
boys,
do.
and there's a girl on the way.
Girl on the way.
We want. I'm very old-fashioned. I shouldn't have to pay for a wedding, so But here's talking about goals. That's very old-fashioned, isn't it? I suspect.
I think it's quite
I did
old-fashioned.
contribute to the wedding that we've had. Yeah,
Oh,
I
well.
turned up.
You probably
That was very
Died.
kind, very kind. Jamie, talk about goal investing, using our technology to set goals and invest for children.
Yeah, it's probably worth you kind of just linking it back to my sort of situation. So a couple of areas I'm focusing on. One, I want to make sure when Jack turns 18, he's got a probably too early for house deposit these days. When I was younger, it was probably a house deposit, but whether he wants to buy his first car or could help him with some money towards university. So that the reason why I put money in a junior ISA. And all I've set up is I think I put £50-60 away a month into that ISA, and I don't anticipate putting any more than that. That'll be over 18 years. That'll be a sizable amount of money for him, and that'll hopefully help him through his first couple of years of university. So it's kind of a real aim for me is that as he turns an adult, he's able to have a pot of money, and that will be up to him what he wants to spend it on. Because you've got two options. Obviously, as soon as your junior ISA, as soon as they do turn 18, it's their ISA. I had this conversation with a friend of mine I've been giving advice to. He's got two children as well, and he had a different thought process to me, which was, I'm not sure my children at 18 will be ready for that level of money. So I'd rather so we've actually, for him, we've invested in his own ISA and some in his wife's ISA, and he's got it targeted in the system. So in the goal and True Potential, he's got his goal to say, this is their fund, and I know I want it for 18 years' time, but it allows him to control it at that age.
Yeah.
So very different approach to what my thoughts are, in terms of I want hopefully I've taught him by then that he understands it, but he could just go and blow it on whatever he wants at that point. But my friend has said it's very, very different. I think that's where the goal planning is. It's people have different opinions on it, but I'm sure we've probably got something similar.
Yeah, I think setting a goal and it's in life. It's lovely to achieve something, isn't it? Hit a target, and saving for it must be very crucial. Interesting there that you see people have a different kind of outlook on things. I'm thankfully now lovely. I'm a granddad, so it is possible. Younger people with younger families starting out, you don't always have a lot of spare cash yourselves to invest.
Very true.
Very true. So it's nice to get the habits of regular saving, is what we mentioned. Interesting from a grandparent's perspective, there are tax allowances and things grandparents can do to invest for their grandchildren. And usually when you get to be a granddad, you've got a little bit more cash. You start to think, what's available for grandparents these days, Jamie? What can they do?
Well, they can invest in a JISA. They typically have to go through the I say JISA, junior ISA, using abbreviations there. But they can typically go through that method. They'd have to go through the parent, but they can do you can easily set up a regular saving from that point. And that's a good way of putting money across. We have some grandparents that will just set up general investment accounts for children, so they don't necessarily, they'll have them in their name still. It's quite an easy way for them to control it, but they can save it through that. So you can still, I think the key is about, if you want to save for your children, it's just choosing about accessibility of when you want it your child. Do you want it to do it on your death, or it's a long time for you, hopefully, Steve? But
why did you look at me?
I don't know. But yeah, I think it's the same with my friend and myself before. It's there's different types of products, but it's really about accessibility at that point for you.
I think a crucial point again is, and you'll get clients probably ringing up, and if a grandparent wants to start thinking probably about an inheritance tax problem where they can make gifts out of income, start giving their estate away, and they want to.
I think it's quite an important point, actually, Steve. You've got, if you're starting to get that level where, and a lot of people do have the inheritance tax problems just because of the value of their property these days. It's caused that inheritance idea. So if you're looking to reduce that, gifting is a great way. There's limits on gifting, but you can do that over a period of time. It's out of your estate within a 7-year period, tapered if you go over them limits. So that is an option, but you can also obviously do insurances to prevent against that. So if you have money in your estate that's earmarked for your children and you've got an inheritance tax problem and you want to mitigate against that, we keep saying this all again, but speak to your financial advisor. There's different routes. Everyone's different, but speak to your financial advisor and they can help you.
You check the words right out there. In the terms of meatloaf, recently passed and missed, you took the words right out of my mouth, Jamie, because I think it is that. It starts to get, if you feel it starts to get a little complicated and you need to take financial advice, we're here at the end of the phone to get one of our advisors plugged in and do it and move forward. Okay, it is interesting about habits. One of the things, we have some awful phrases in the English language, don't we? Sort of little things say, youth is wasted on the young. And I think it's always said by really bitter old people. Let me tell you, as you can see from my face, my youth was not wasted. I've got to this age of 35 and I've lived life to the full. I think, I don't agree with that at all, other than in one instance, and I think it's the instance of time. Time is on the side of younger people. Yeah. So I think, again, it's looking at regular investments, start as early as you can, and start to get the money on. And I suppose compound interest. And I mean, it happens in your world, Jeff, doesn't it, that certain companies, like compounders or whatever, they reinvest dividends or whatever. Yep. Give us some, I don't want you to quote the exact figures because this is putting you on the spot, but some instance where, what would the market returns be with, if income was left invested and not taken?
I think for all of us, it's to use income to your advantage. So reinvesting and using the opportunity that regular savings or regular income provides is really important. The compounding effect of a small incremental increase can be very significant over a period of time, particularly the period of time like Jamie's talking about 17, 18 years, compounding up over that period of time on 5-6% returns, but reinvesting an incremental 1%. You're certainly compounding much faster. The ability to achieve your goals sooner is there, and it's very evident when you can see that in your goals to use compounding to your advantage. Doesn't have to be very much, but it makes a big difference over time. And I suppose that's where we forget about the education side of things. That we'd hear about compound interest in a maths class, but you forget about it because it doesn't really have any consequence. But then when you actually start to look at it in our industry from a savings perspective, it's actually a very, very powerful tool, which we forget about.
When I was studying for, you're probably the same with yourself, when I was studying for my level 4 financial advice exams, it was one of the calculations that you had to kind of go back and scratch your head and go, right, so how do you do compounding again? And then you go, right, so I should have listened in that maths class that period of time, but it is quite relevant.
Yeah.
It really is quite relevant,
So
just to understand
in,
percentage.
in investing, so relevant.
Yeah.
I don't want to scare anybody because that's not what we're here to do, but my generation, I think the pension provision, that even though pension legislation has changed over the years and we've got pension freedoms, which are a great thing, the provision by our employers of a pension when I was younger was greater, I suspect, than the younger people are seeing now. So I have a pot of money that are built up of pensions. You guys won't have it. So it is crucial, isn't it, that you get people started as soon as possible.
Yeah,
Get your
I mean, I don't think you realise that. Like, for me personally, until I started working here, I just assumed that there was going to be some money handed to us when I reached retirement age. You don't think that actually you need to save for it. And if you want to have some form of life, once you've reached retirement, which you've worked for, you need to start doing it as early as possible. And I think that's something, that message really needs to be spread. One, I think technology massively helps it. So you can see these days, it's not just like what you said earlier, it's not blind, you can't kind of forget about it. It's accessible, it's there, and younger people now, everything is about technology. Everyone has phones, iPads, tablets, etc. So I think using all of them tools and actually just speaking about it more for younger people, for me, it would have impacted me sooner rather than later.
That's a really good point, Haley, and I don't mean that in a patronising manner. At what age did you buy your children their first phones? If you bought them already, I don't know. Maybe you haven't yet. I don't know. I'm trying to think when.
It's funny you should ask, because my oldest son just got one on the weekend, so 12.
12.
Yeah.
Right. I think when they went to upper school, we let them have phones. The point I'm making is you talk about technology. I suppose using our technology on the phones that we would buy our children, it's a great, when they're young and little, we start a junior ISET. When they get to that age, just about to go to upper school, get them a phone, but put a True Potential app on so they can see impulse saves and how we grow our we can grow our portfolios is a really good thing. It's the use of technology which.
Jack got his first phone at 6 months. It's one of them Fisher Price ones. press the button and it's a dog and it's woofing. Doesn't quite yet have the TP app yet, but
Well, you need to have
Never
a
know.
look. Development can probably do that. They can.
Get in touch with Fisher Price.
Yeah,
No, it is interesting how we do it. But I think the theme that's coming through loud and strong is, it's different education at different stages of life for the kids, isn't it? It is interesting. My kids, as I say, are sort of mid-20s now, and they're looking at buying houses, and it's proving really difficult.
Yeah.
So, there is a sense of regret that we didn't save enough for them. I mean, I might have to give them some of my poor wealth to do it, but I wish we'd started earlier. But it was difficult because money's tighter when you're younger.
Yeah.
But I wouldn't have noticed £50 a month or whatever it is. So it is a crucial lesson. Start.
And then I suppose incrementally as well with the impulse save. If it's not 50, it could be 10, it could be 5, it could be anything. So there's, as Haley says, technology creates that opportunity.
Yeah.
And impulse save really creates that opportunity that if it's not as frequent as a direct debit, but there's some spare cash, I'll just save that off.
Yeah.
I mean, that's, a great point. Impulse save is something that could really motivate younger children, isn't it? On the rewards system that we've got. Do you want to tell people a little bit about the rewards system?
Yeah, so in the applications now we have a new rewards technology where you log in the app and it gives cash back on a lot of major providers. So like some Marks and Spencers and Just Eat and things like this, you'll get percentage cash back, and that cash back gets automatically invested back into your investment. So I think I had I can't remember if I had a takeaway on Wednesday, Steve and I got, and it was nearly 56 pence that was back in the investment. So it was actually less than that. It was about 16 pence. It'd be an expensive takeaway if it was 1% for 56 pence. It was about 16 pence.
You probably eat a lot, Jimmy.
It's only two of us. And
I mean, the interesting thing there again is though, it motivates you to get your 16p, but it would really motivate Jack. And I don't know your son's name, but I should do. Shouldn't I? What's it called?
Freddie.
They would be really. That would if they could see it on their phone.
Yeah.
So we would, when people ring, if you need to know about our technology, call Haley's team. Jamie's advisors can help. We can do it and move forward. It's getting good habits, isn't it? And just about to be able to use the phone now. And frightening, isn't it?
It's very frightening.
Okay,
Got the first text message back. Can you
did
pick
you?
me up now?
Oh,
It's like,
that'll be
have I got a helicopter? I can't get there in that space of time.
That's what my auntie was telling me at the weekend. I was talking about the phone. She was saying, you find it difficult now. It's when they get a bit older and they're going to every club under the sun, and then they want picked up on a night time, and you become a human taxi driver for them.
That was one thing my mum and dad said no to pretty much straight away. Is if you
up.
go out, you taxi back. You get there, you can get back.
Yeah, when they get into the 20s, there's different problems, let me tell you. They sometimes get back, but then getting in the door seems to be a bit of an issue. I've probably all had that problem at some point in the past. Yeah, I've experienced it. Even this Christmas, we experienced one of them asleep on the lawn in the morning.
Oh, no.
Yeah.
Oh, wow.
Anyway, I can't discipline them anymore. I obviously didn't discipline them when they were younger. Let's just capture some of the messages before we move on. It's the discipline aspect, not punitive, making sure there's an incentive. They can see it using the technology.
Yeah.
Certainly using things like Impulsive, a great idea because it's a visual, it's a very visual, it's self-rewarding, isn't it? And you can see it instantly. And use time, get them going as early as they can.
Great.
If you're a grandparent, look at ways of passing wealth down to your grandchildren using our technology and funds again and do it. Compounding interest, compounding savings. The good thing about a junior ISA, you can't touch it till you're 18, can you? It's stuck, you're in it and you're building. So great, it's locked in. Okay, I hope that's been helpful. And then now we move on to the start of the podcast, which I always love. It's that we have to talk about our weekends, Haley. So what have you got? I know it's probably you're a bit restricted these days.
Well,
what have you got planned for the weekend?
I am at a surprise party, and I'm not going to say any more than that because I
It's not for
will
you,
drop
is it?
myself in it.
All right, that sounds exciting.
Yeah.
But you won't be drinking much at the minute.
Unfortunately, I'm on water or juice.
Oh, dear.
You could be the taxi then. Yeah.
Exactly.
Jeff?
A little bit of rugby. Started the Six Nations. Quite an interesting fixture this weekend. So
Yes, England are going to beat the Scots, aren't they?
I think it might be the other way around. But we'll see.
Probably. Yeah. But nothing else, just rugby and
Just rugby,
chilling out and
chilling out,
partying. Over to you to excite us then, Jamie.
No, I think I was wondering if my granddad would take us out. But it was a bit too.
Well,
Bit of a low blow.
I just wanted to get onto what I was doing, as usual. I'm going to have a really exciting weekend because Bradford City are playing Harrogate Town.
Oh, wow.
It's a big game
Yeah, I was
in our
going to
region.
say.
And I managed to get a ticket. Yeah, but I'm sitting with the Harrogate fans.
Oh.
So I think there'll be 3 of us in their stand.
Is the way, is it?
It's away at Harrogate. Have you been to Harrogate?
I
It's
have,
a
yeah,
spa
it's a
town.
nice place.
Yeah, lovely place. But
I lived in Harrogate for a year. Fun fact.
Oh,
There you go.
really?
Mm-hmm.
Well, it'll be invaded by Bradford City supporters. I wouldn't go this weekend, is all I'm saying. But yeah, I'm doing that. And I'm going for dinner. And then I'm starting to walk it's called the Dales 30. It's 30, they call them mountains, but they're not really mountains. But we're Yorkshire, so it's mountains. So we're starting the Dales 30 on Sunday. We're
How
going to
many
walk that.
miles is that in total?
Good point. It's not a lot of miles, and
Lot
we're
of
going
height.
to Whernside here, which is I've done it before, but my wife hasn't, so I'm pretending I haven't because we have to.
Does
do
it involve walking to pubs, Steve?
There will be a pub at the end of it.
Yes, I thought
in
it
my
was.
new walking boots, which are arriving today from Amazon. So I'll have blisters on Monday.
I was going to say,
Don't
they'll
wanna
be
break
done
those in
come.
tomorrow.
No, that was a bit of a stupid mistake, wasn't it? But, well, I hope you've enjoyed it. I hope we've given you some tips that you can use when talking to your children and helping them invest. If you have any issues, you want to talk about things, as I've said, please get in touch with us. I have either technology or call into Haley's team or Jamie's team. But from here, it's been lovely talking to you, and we look forward to seeing you again on the next podcast. Thank you.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.